This is CNNfn, the financial network.
Okay, so, right now in the stock market, there are people who are pretty bullish. They think that we're going to get a big boom in the economy because of President Bush's tax cuts. They think we're starting to see some signs of that now. They say, hey, don't be hesitant to get in here because this market's going to move even higher. You think the easy money has been made. What's number one reason on your list?
Well, the macro climate looks a lot better now than it did last spring. In April, I would have taken any client's money and put it to work immediately because things look terrible. Now they don't look so bad. We're sitting in the Middle East. We're kind of forgetting about terrorism to a certain degree. Corporate earnings look pretty good. People aren't afraid of stocks anymore, so now the risk is dialing up again. I don't think it's too late to be involved with stocks, but the opportunity to make 20%, as we've seen since April, I don't think that's going to prevail.
So if there's a risk, is the risk that you put your money in and it doesn't grow 20%, or is the risk that you put your money in and lose some?
I think reasonably speaking, I see stocks growing 8% a year for the next couple of years. We're into a new economic cycle. Valuations are fine. The earnings forecast for this quarter and next year look pretty good. But 8% is the speed limit on the stock market, historically speaking, so to expect 20% year in, year out, that's foolish.
Okay. So how do you factor in the employment situation? We continue to see high-profile layoffs at big companies. The new claims for unemployment benefits are really basically stuck around 400,000. The trend has just been to kind of plateau around there. It doesn't spell disaster, but it doesn't spell net hiring in the economy yet. So how does that factor into your view of the stock market?
There's two ways to look at the employment situation. One is to say, well, under the Clintons, employment grew 12 million jobs. Under the Bushes, it's down 3 million. Another way to look at the same information is say, well, over an economic cycle that extended through 2 administrations, we gained net 9 million jobs. Normally, you'd expect to see jobs increasing by now, layoffs ending. We saw 1,000, I think, in the International paper this morning. But there's two counter trends here. One is productivity, which is huge, and the other is exporting skilled jobs. You pick up, you call your help desk for Dell Computer, for example. These days, you get to India. You don't get to Texas anymore. It used to be you called Citibank, you got to North Dakota. Now you're getting to China. So the jobs are going to be stickier on this particular cycle. They'll start picking up through next year, and I think that'll be probably good news for the Bush administration.
Okay, so that's another thing we should be watching then, I guess. If we did see jobs picking up, we could say, aha, I can get a little bit more bullish maybe about companies, earnings, stocks, profits, etc. What else is on your list in terms of a yellow light at this point?
Terrorism. I would say I spend about 2 hours a day trying to keep tabs on what's happening in the Middle East. We just got past the 9/11 memorials, and everyone goes back to work. It's kind of falling below our radar screen. And yet the history of Al-Qaeda is a major hit every 2 years. So every single stock that I have in my portfolio, I examine it in terms of if it's an airline stock and we have another three-day shutdown of the airline industry, that's probably it for those companies for good. I don't own any airline stocks as a result. If I hold a property casualty company, I might prefer AXA, which is internationally distributed, as opposed to Marsh & McLennan, which is domestically distributed.
Well, that's a very powerful statement, I think. Because I think many people feel, I don't think we really have our heads in the sand, but I think the longer something doesn't happen, the more that the war is in Iraq or the war is in Afghanistan, I think people feel that this, it's not that they don't worry about it, but I don't think they view it as a threat to the economy of the stock market right now.
Right, and that's exactly why Al-Qaeda faces these things every 2 years. They know that we will forget, and then they come back and hit us again, and it hurts twice as much.
So, looking down the road, then, what would you say? Again, how should I diversify my portfolio right now? Should I put something in international funds? The bond market had a sell-off. Should I stay away from bonds? If there's some kind of sector of the stock market I should look at. If I'm trying to look at my portfolio, what advice would you give me?
Right. Well, first off, I look at the statistics and I see a lot of individual investors going back to technology stocks. Probably a little bit too late. Now they're up 40% on the year in the NASDAQ. I see them buying it on margin. And I say to the average investor, limit your technology exposure to about 25% and limit your margin borrowing, if you're going to do it at all, to about half of what you could do. Because if you reach and then the market falls off, you'll have to liquidate it at fire sale prices. Other than that, keep some money in sectors that are not harmed by a terrorist attack. Healthcare, for example. People are going to go to the hospital, whether their economy is doing well or badly, whether the bombs are falling or not. So keep some exposure there.
Okay.
Bond market was very bearish about it in the spring. Now that we're up 1.5% in the yield curve, I don't feel so negative about that. Like the high yield sector and corporates better than munis and governments.
Okay. Well, you gave us a lot of good rules of thumb to go by, David Edwards. We'll look forward to seeing you again soon and see how some of these pieces of advice play out.
Thank you.
This is CNNfn, the financial network.